Hi, it's Esther, and I want to welcome you today to an investment briefing. We thought we'd do something a little bit different for you and hold an investment briefing that you can watch at your own leisure and share with your family or friends if you like. We put this message together to share some timely insights into what's happening in financial markets, how recent events might be affecting your portfolios, and what we're watching closely as we look towards the medium and long term outlook. In a world where headlines are often dominated by uncertainty, whether it's interest rate movements, inflation pressures, geopolitical events, or just regular market volatility, it can be hard to know what's signal and what's noise. That's why we believe that it's important from time to time to pause, to reflect, and to offer our clients a clear and informed perspective. I mean, you all have your regular reviews, which is great, but sometimes there's noise out there in the media that makes people a little bit uncertain if everything is still okay. And even though we don't hear from you, we're still monitoring things in the background. And of course, if at any point you feel that you need a little bit more reassurance with how your funds are invested, or if your strategy is still meeting your goals, by all means, please be in touch. Be in touch with us. So we're going to share some insights today. And what we've done is we've invited our very good friend, Ross Cassidy from Morningstar Wealth, to come and share some insights with us. Ross is an expert. As you know, I deal with the high level strategic side of managing your wealth, but I tap into resources like Ross who can provide expertise when it comes to what's going on in financial markets. When I'm out there talking to you, I don't know what markets are doing, but he's eating, sleeping, breathing markets, and he'll be able to share some insights way better than I'll be able to. So let me introduce you to Ross. Ross is an investment specialist at Morningstar. He's actually responsible for delivering Morningstar's investment and wealth management solutions to advice firms around the country. He has over 15 years' experience working in the industry, including roles at Bendigo Bank, NAB, Citibank, and UBS. He's continued his studies post completion of his Bachelor of Business and Accounting, successfully finishing a graduate diploma in Applied Finance and Investment, and is certified investment management specialist. With a keen interest in behavioural finance, Ross completed several short courses looking at the impact of behavioural finance on investment decision making, and has been at the forefront of presenting Morningstar's behavioural research to Australian advisors. Prior to joining Morningstar, Ross was a senior business development manager at Zenith Investment Partners with a focus on managed accounts and the needs of advice practices around the country. That's a lot of information about Ross. Ross, I've known you in multiple roles that I've just mentioned, and it's really a pleasure to invite you and to have you here as part of this briefing. So thank you for making the time to share with myself and with my clients.
No, thank you, Esther. It's a pleasure to be here and be able to speak to you and hopefully share some insights with your clients.
Thank you, Ross. So let's get into it. We don't want this to be too long. We want it to be short and sharp and get to the point. And we're just going to cover off on a few questions, and hopefully that'll really get to the gist of what people want to know about what's going on in the markets. So here's a place to start. From the lows of, well, in early April, we hit a bit of a low post Trump's Liberation Day announcements, and markets rebounded pretty strongly over the second quarter. Can you talk to us a bit about what's been happening in the markets and how his announcements have impacted um, the equities markets?
Yeah, absolutely. It has been a bit of a roller coaster. I mean, at the you had the first quarter where there was a lot of noise, a lot of uncertainty. Trump obviously had been elected to power and had come into office. There was talk of tariffs that were going to happen and those sorts of things. But when he did come into office and did announce all of those, markets sort of wobbled a little bit, and we did see that they did sell off particularly through that first quarter. It all kind of culminated in, as you pointed out, Liberation Day, which was in early April. And then over that sort of couple of day period at the first week or two of April, markets sold off significantly. We had the US selling off, around 10 or 11%, similar sort of quantum for Australian markets. But then that changed really, really quickly. So we know that not long after Liberation Day, Trump announced that there was a pause to the tariffs. And when the markets received that news, they rebounded very, very, very quickly. So let me just share a screen with you, which might sort of show you that in a little bit more detail. What we've got here is, basically from the very lows of that Liberation Day announcement through to the middle of July. So you can see here between early April, the US market was down about 12.5%. Global equities in general was down 11.5%. Australian equities was sort of 5.5%. But after those pause announcements, you can see that markets rallied significantly, and the US is up 27%. Global equities are up 24, and Australian equities are up 17. So in totality, from that point, US markets are a positive 11, global markets are at 9.9, and Australian markets are also positive 11. So, that's kind of what's been happening in markets. To your point, when you sort of started off, Esther, I think it was a really timely reminder that if you do have a strategy, stick to that strategy. Try and drown out the noise that you do tend to get from print media and those sorts of things. So, engaging with your financial planner, sticking to the strategy, making sure it's still relevant if your circumstances do change. I think is super, super important when you do get those bouts of volatility. Don't overreact to the noise, just stick to your strategy.
Right. And I guess with your behavioral finance hat on, I mean, you would understand that people hear the news, they want to make decisions. Should we pull in? Should we pull out
Yeah.
of different markets? And we both know the risks of trying to time the market.
Yep.
None of us individually have any more information than anybody else. And, as we stick to our strategies over time, that ends up proving to be the best outcome because, you could be out on the wrong day, in on the wrong, out and in
Yep.
on the wrong days and in the wrong
Yep.
moment. And you've completely pulled the rug out from under the stability and the performance of your investments. I do often have clients come in and say, well, Trump said this and Trump, and there's a lot of references to Trump. And what I try to remind my clients is your money has to your money has to last longer than the term of Trump's presidency.
Yep. Yep.
Okay, so he will be up and down with all different things, and yes, it'll impact the market 1 minute this way, 1 minute the other way. But at the end of the day, he's got a 4-year term,
Yep.
and he'll probably still make a lot of noise after that because that's just who he is. But in terms of how he impacts the world economy, that's a very, very short-term impact. And well, the people that I'm working with, their money has to last way longer than Trump is likely to be in politics or even be on this be on this earth.
Yeah.
So I think when I put it into that perspective, it makes people realize, yeah, that is true. Why are we listening and getting pulled down to all that rhetoric when, yeah, we're going to be here a lot longer than he is?
Mm, mm. The flip side of that coin is, so again, with that behavioral finance hat on, is, in the short term, you do have people who participate in markets who do overreact to short-term noise and those sorts of things.
Yep.
And that creates advantages for long-term investors. So if you get assets that are oversold because of a particular Trump announcement or something like that, if you take the longer term view and you've got professionals who are looking at your portfolio, day in and day out, there's opportunities that present, and you
Right.
can you can pick up assets, on discount almost,
Yep.
and take advantage of some of that volatility. So that's the flip side of the coin.
Right. And that's good because people like you are looking out for those opportunities. People like us or our clients are looking at things on a more macro high level. They might make one decision
Mm,
and that's the decision in the moment. Whereas you're looking at decisions that a lot of different people are making and then saying, right, how are we going to profit and maximize our opportunities moving forward based on all those decisions. Some might be good, but some might be just impulsive and emotional.
Yeah.
So I think it's a great partnership, having the support of you guys who really, as I said in the beginning, are living and breathing investment markets. So that probably is a really good segue, kind of into the next section, next question, which is, there is a lot happening geopolitically all around the world in a lot of different countries at different levels. So what do you look at to navigate that uncertainty?
Yeah, no, absolutely. Lots going on. I mean, we've spoken a lot about Trump already and his tariffs and trade policies and the like. There's not a lot of headlines anymore about Russia and Ukraine, but they're obviously still at war and that's bubbling away. And then we've got the drama that's sort of happening throughout the Middle East as well. So there's a lot that's happening. Again, just trying to bring that back to a longer term view. Take a longer term view with investing, but also, we think diversification is very important within
Mm,
the portfolio.
yeah.
So again, just, let me share a slide and hopefully you guys can sort of see that now. This is just the return of different asset classes through time. You can see the legend down the bottom here. So if we look at Australian listed property in green, you can see in 2005 it returned 18.4%, but in
Mhm.
2009 it was negative 42%.
Wow. I
Um,
love this.
so
I love it for a couple of reasons. Number one, it's very colorful, and anyone who knows me knows that I really like color, number one. But also, yeah, that is just the perfect slide to show that there is no one market or
yeah,
one asset class that outperforms every single year
yeah.
consistently.
Yeah, no, absolutely, absolutely. I often, sometimes jokingly, Esther, bring this chart up and I say to people, "Can you pick the pattern in this chart?" And they look at me quizzically and "No, I can't." And I said, "Perfect, that's the right answer. There's no pattern in the chart, and that's the
Right?
point of it." Yeah, so diversification is really, really important. So you don't have all your eggs in the one basket. And obviously, the job that you do in understanding someone's risk profile and how much risk they can take on and where they should be investing across those different asset classes is super important. So that would be the first thing that we would say.
Yeah.
The other one that we would say is in terms of our investment process, we want to make sure that we're, I guess, spending our time in the areas where we're going to get most bang for buck. Okay, so for us, if you think of this quadrant here, we want to spend most of our time in the areas that are really important, that we think are knowable. So from our perspective, we think the price of assets is, really important and largely knowable. So we want to understand what assets are cheap, where are there opportunities, what assets are expensive. So, where do we want to take some risk off the table? So this is where we spend most of our time when we're thinking about building portfolios. The geopolitical side of things, which you can kind of see over here, super important, but largely unknowable. It's, a lot of speculation. You throw Trump in the mix and his policies can change, in a 24-hour period. So, yes, we want to keep an eye on that somewhat, but we don't want to get bogged down and spend too much time in this. So, diversification and just spending our time in the right areas are sort of how we try and navigate some of those geopolitical uncertainties.
Right. That makes sense. And every time the world sort of quietens down a bit, something comes out of left field.
Yeah.
So I think also if you've been around for a while, I don't even mean investments, I mean just in life, you understand that things can come up. If we leave wars aside,
Mm,
whether it's other events, fires,
mm,
um, hurricanes, all sorts of things that can really, really have a significant impact.
mm,
But we really need to, weather through those things, and our money's got to last longer.
mm.
Again, I'm being a little repetitive, but our money has to last longer and work harder, even throughout all those circumstances.
Mm.
Yeah.
Yeah, and, I mean, if you look at that, Esther, and if you look at the general characteristics of assets is, particularly equities and those sorts of things, through the long term, we know that they rise in price, right?
Yeah.
So they're really resilient. Yes, you're going to get these bouts of volatility and short-term shocks, but markets are really, really resilient. So, through the fullness of time, we know that assets appreciate in price. So again, taking that longer term perspective, and drowning out some of that short-term noise,
Yeah.
it sounds really simple, but it's crucial when we are investing.
Yeah, thanks, Ross. So I know we've mentioned Trump a couple of times, and it sounded like we're moving on, but we're going to go back to him just for a moment. So with the tariffs, has that impacted inflation? Like what has it done for inflation here and overseas?
Yeah, so I mean, inflation across the globe is sort of largely under control. And we clearly went through that big spike of inflation as we came out of the back end of COVID. Again, sort of humor me a little bit. Let me just share another slide
Sure.
with you.
Mm.
What we've got on screen here is just a number of different economies, major economies, and you can see through time that big spike in inflation, and we've sort of come down the back end of the mountain there. The light blue line is the inflation number here in Australia. That's slightly dated. The last quarterly read was actually 2.1. But we've been a couple of quarters now in the target band of between 2 to 3%, which is what the Reserve Bank of Australia is sort of targeting. So inflation is largely under control. With Trump and his tariffs, we might get a small spike in inflation, particularly in the US. Tariffs are effectively just a consumption tax. So, that's
Right.
going to increase prices in the US. But it does have the possibility, as an example, to maybe push inflation down in other areas. So, what I mean by that, Esther, is as an example, if China is selling less into the America because of these tariffs, and they've got a whole lot of production that they need to offload, that may go out at cheaper rates across the globe, meaning prices come down. So inflation largely under control. You might get a small spike in inflation in the States, but that might be a good thing for other areas in terms of providing disinflation in those
Right.
areas.
So, Ross, can you explain how that impacts interest rates and people who have concerns that with interest rates coming down, if they're wanting a more secure income or they're relying on income from their portfolios, what the trade-off is, if they're and how we secure that trade-off so that if interest rates are down, there's still income to rely on without taking on too much additional growth or risk in a portfolio.
Yeah, so there's sort of a number of ways that you can do that. Again, depending on how much risk someone wants to sort of take on within a portfolio. I mean, if you've previously invested in a term deposit, a long-term term deposit, as an example, maybe a couple of years ago you invested in a 5-year term deposit, and you've got 5% on that term deposit. Well, clearly that's a good thing for you because you're getting 5% and inflation sort of come way down and those sorts of things. But on the sort of defensive end of your portfolio, in terms of fixed interest and bonds, as those rates come down, without sort of getting too technical
Yeah,
and into the weeds, bonds and fixed interests have an inverse relationship with rates. So when rates come down, bond prices go up and vice versa. So as those rates are coming down, your bonds are appreciating in price.
mhm,
So you get a bit of an uplift from that perspective as
right.
well. So yeah, I don't want to dig too far into the weeds with
Yeah,
that because it can
yeah.
be a little bit
Mhm.
technical. Yeah, but hopefully that sort of answers your question.
Yeah, it really does. Thanks, Ross. And so then, where do Morningstar currency opportunities to invest within portfolios right now?
Yeah, yeah. So
And those opportunities, not just in Australia, globally, where are some good opportunities?
yeah, yeah. So we tend to have a preference in our portfolios for global assets as opposed to domestic assets. We're really conscious of the fact that Australian the Australian economy only makes up sort of 2 or 3% of the global GDP. It's 2 or 3% of global markets. So, we do look beyond the shores of Australia when we do invest. And there's sort of a number of opportunities that we're seeing at the moment. Again, I'll just sort of share my screen here. The areas that are probably looking less attractive for us. You can see I've sort of highlighted in red. These are just some of our forward-looking return expectations of, some of the assets that we try and understand fair value on. So you can see the US, we think is expensive compared to other markets in totality. So, the big tech names are quite expensive. So, there's risks there. Australian financials, so the banks here, probably led by CBA, are looking quite expensive. So, we're looking to invest less in those areas and find assets that are a little bit cheaper. So, in terms of the assets that are looking attractive for us, US healthcare, as an example, is a
Okay.
sector that's looking attractive. European healthcare as well. So, as I said before, sometimes the volatility can present opportunities. One of Trump's current policies is in and around how much Americans are paying for their medicines. So, pharmaceutical companies have really sold off on account of that. So that's sort of creating an opportunity, and we're sort of investigating. You can also see that European energy, European consumer staples, and European consumer discretionary sectors are also important. So, as an example, there, European consumer discretionary, what we're really talking about are those luxury European brands that my wife, I know, is certainly familiar with. You're talking the likes of Louis Vuitton, Burberry, Kering, those sorts of names, and those stocks have sold off quite heavily. So, they're the areas that we're seeing opportunity. And as I kind of said up front, what we're really trying to understand is what are the assets that are expensive and what are the assets that are cheap. And then we look to invest in those that are cheaper than those that are expensive. And that's how we kind of build out the portfolio.
Right, right. And you've got offices all around the world, haven't you?
We do, yeah, yeah. So we've got over 11,000 employees across the
Wow.
globe.
Mm.
So our head office is in Chicago. I'm obviously based in Melbourne.
Yep.
We've got offices in Sydney, Brisbane, Hong Kong, South Africa, London. Yeah, we're spread all across the globe, Esther. So, one of the advantages of, I guess, working with Morningstar is that global breadth and depth of team. So,
Mhm.
when we do invest internationally, it's not a couple of guys in a Collins Street office trying to understand what's happening, say in German equities or something. We've actually got people who are over there who are closer to the action, and that they can sort of provide that information to us so we can make smarter investment decisions.
That's good. Ross, that's been great. You know how it is with investments for most people. We start to gloss over. I start to gloss over if we get a little too technical and too in depth. This is actually the first one of these type of briefings that I've done for my clients in
Yeah,
this format. So it's really been wonderful. Thank you for sharing high level. I'm sure we can come back to you if anyone has any questions or would like a copy of the slides. We can
absolutely.
access that information, and perhaps this is something you can do with us again in the future, and hopefully we'll get some positive feedback from it.
Yeah, I'd love to. Hopefully, I haven't gone too technical there, and your viewers haven't glazed over. So yeah, no, it's been a pleasure to be here and share
Thank
some
you.
insights.
No, that's great. And to all of you who've watched it to this point, it's really important to us that you provide us with feedback so we keep doing things that ultimately bring you value. So please share with me whether this was something you found useful or not, whether you'd like more detail, whether you'd like more high level, or any type of questions that you might have in the investment space. And we'll make sure that we'll keep customizing it for what really hits the mark for you. So until I see you in person, be well. I'll see you soon at your next reviews. And Ross, thank you so much. I'm sure it won't be long till we cross paths somewhere around the traps.
Absolutely. Thanks, Esther.
Okay,
Cheers.
keep well. Thank
Bye.
you, everyone. Bye bye.